The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everybody. This is Reed Warren and Mike Harvath, and today we're going to be taking a look at trends in mergers and acquisitions and what their valuations are. Hello, everybody. Welcome you to that.
So, Reed, without further ado, take it away.
Won't keep the pictures up too long here. But as we get started here and as people come on, this is the third in the series that we've done. We do have the previous two webinars that we've done on our portal, so you can view those really on post-merger integration and M&A readiness. Today we'll be talking about valuations, and then on May 20th, we'll be looking at what's involved in due diligence. And there's a lot of misconceptions there, and we want to be able to speak through what you need to be ready for when we address, when you get into that due diligence stage. As we look at the market, just as a quick highlight for M&A for buyers, and here in 2014, the appetite was definitely on the rise. 47% of companies out there in the IT space saw that they're going to grow both through organic strategies and acquisitive strategies. 29% were going to be done mostly through acquisition, and 24%, additional 24 were saying, hey, just pretty much all organically. So when we look at that, you have about 76% of the marketplace that is, or IT services companies that is in the market for doing acquisitions. And this is definitely an uptick from the previous years, and becomes really critical then as we look at what are the values for making those transactions happen. Excuse me. Those are happy when they happen.
Couple items here on buyer readiness. Our opinion is that buyers are ready when they're larger than $5 million on annual revenue or $3 million outside of the U.S. This is a guideline, not a rule, as there's many companies that are merging and buying that are smaller than $5 million. Caveat that I would add is that they're primarily ones that have a strong balance sheet and are looking for a strategic combination. So they look a little more like a merger than an acquisition when they're smaller than $5 million. But in general, this is kind of the rule of thumb for IT services companies. Quarterly companies that are doing acquisitions and or mergers have a clear organic growth strategy in place. And we're believers in the rule of 45. We've done some publishing on this, and in essence, what this is all about is on a 3-year average, IT services companies will have a tough time if they're above $5 million in revenue, taking their year-over-year growth rate as a percentage and adding it to their net income on a percentage and exceeding 45%. And that's on a 3-year average. So if you're optimized as a business, have a clear organic growth strategy, and are sort of living within the rule of 45, you're in a good position to do an acquisition. The ideal, the holy grail of growth and profit in IT services is a 30% year-over-year growth and a 15% net income. Clearly, if you grow a little faster, it's going to impact net income. So in essence, you can grow 35% at about a 10% net income, or 40% at a 5% net income. And so that's the overall premise on Rule of 45. There was an article written in the Minneapolis Star-Tribune about the Rule of 45 and our opinions about it. You can find it on our website if you'd like more information. Clearly, the business is focused, and the revenue is growing at least 10%. Of the market growth rate per year. So keep in mind that the market itself is growing at about 10% overall. Now, there's various areas in the business, like in BI and in some cases in infrastructure managed services and others that may be growing quicker. But in essence, the market baseline is growing at 10%, and you should be growing at 10% in excess of that. That your business should be best in class in profit. and that your processes and vertical markets are well defined. These are critical components that your strategy has been fortified. Clearly, that you have a desire to accelerate your growth is important. You're going to do that in spades with an acquisition, so you have to have a healthy growth appetite. You have to also be financially healthy. I'd recommend that you have little or no long-term debt, and that you're managing the business well from a cash flow perspective. I think it's going to be challenging. The short answer there is that most acquisitions are funded either from companies with cash on the balance sheet or much more commonly through some sort of leverage. And that leverage is typically a loan from a bank and or a combination of seller financing. And clearly that you're in a position to take some risk. M&A is not without risk. Risk can be mitigated clearly by having a strong, a significant due diligence effort done on a potential seller or a merger candidate, as well as your ability to, plan an effective post-merger integration, which we have covered in a previous webinar. Reed?
Yeah, thank you. And so when we look at multiples and trends, it's really important here to remember that these are, this is not a valuation. So in other words, a transaction is measured as a multiple of typically EBITDA or of revenue, but it's not a formula for coming up with the value of a company. And so when we look at those multiples, they really are benchmarks. They're ways of being able to say, hey, here's where transactions are going, and whether it's increasing or decreasing, and provides benchmark data. And like I said, can't be used as a substitute for evaluation. It's really about profitability, not revenue. Again, a lot of the multiples are actually presented as multiples of revenue, primarily because companies don't want to disclose their profitability or disclose that to the marketplace. And so you'll see a lot of, everybody's seen them, you'll get emails all the time saying, company A bought company B at, 1 times or 1.2 times or 2 times or whatever the multiple is of revenue. That gives you some sense of the transaction value, not necessarily how they came to that. Most private transactions are reported in terms of those, just to keep the information confidential. And really what comes together here for creating what the value is really how does 1 + 1 = 3? And that is how you can get those multiples for a strategic purchase with a good cultural fit and good financial fit. You can get multiples that are well in excess of what we're going to be talking about today. So we see typically as multiples on a transaction, if it's not strategic and it's pretty general, the seller is a generalist and they're in a depressed market, you can see multiples in the, on the lower, 3 times trailing 12 months EBITDA. Companies that are very strategic, very focused, where there's good alignment and great synergies, we're seeing multiples sometimes as high as 10 and 12 times that trailing 12 months EBITDA. All those, that full range gets averaged into the values that we're going to be talking about today. And so as we look at multiples and trends, what we're trying to show, and particularly in this slide, is that in 2013, excuse me, and the 2014 report should be coming out shortly here. But we want to be able to show that the profitability of an organization has everything to do with the multiple that's behind it. So companies that are running in that 5–6% trailing 12-month EBITDA are typically going to have a lower multiple of revenue. Companies that are running far more profitably, 12–14%, are going to have a much higher multiple as a result of it. And so typically, if you're above in the IT services industry, if you're above 12.5% EBITDA, then you're typically going to be in a top quartile performing company in the U.S.
I do see that, Steve, Connor, you're asking a question. I'd ask you guys all to hold your questions. We will use the hand raise option in GoToWebinar when we get to the question section, and Steve, you'll be the first on the list. So as we read, I don't know if you want to continue on your conversation about multiples. You're on a roll here. Why don't you talk a little bit about this slide?
So as we look at it in 2013, and we've seen that actually the numbers go up here in 2014, but we were seeing that typically the multiple on revenue is about 1 times revenue or just under that, and about 7.4 times the trailing 12 months EBITDA. We see particularly the multiples on the EBITDA have increased for those companies as they get more profitable. But this gives you a sense of where it's been in the past and where it's starting to head to as we look forward. When we look at the transactions that were done in 2013, 40% of all the deals actually happened for transaction values under $5 million. 80% of the deals happen on transactions under $40 million. And so as you look at what's happening in the marketplace, you're seeing more and more of this consolidation occurring in the sub-$5 million space, and especially under the $40 million space.
I would also add, if I could just interject, that before we move into this slide, clearly we learned that in 2014 there was about a 9 to 10% increase in volume over 2013. And so clearly there's an acceleration in the amount of consolidation. So as 2014 data comes out, I think you guys are going to find it fascinating. I suspect that based on our share, we're going to see multiples continue to go up, and in some cases pretty dramatically in various subsectors of IT services. And we're going to see a lot more deals happening. I think we're going to see actually these numbers for deals under $5 million go up pretty dramatically. We're seeing a shift towards smaller deals in tech services. There just is fewer large companies, frankly. Many of them have already been consolidated out. And so we're going to tend to see more and more transactions in smaller companies in 2014. As we look at valuations in deals at the highest level, we've always positioned, the deals get done on a metaphor with a football goalpost. And sort of on the left side of the upright, we have the historical value. Historical value of the businesses are typically based on, weighted capitalization of earnings, weighted billing value, book values, et cetera. Our valuation models actually include about 7 different approaches on historical valuation that are weighted towards cash flow models because clearly it's all about earnings when you look at valuations and not about revenue or book value in IT services companies. And then there's a consideration for future value. Future value really has to do with, a discounted cash flow on your projected growth rate on that acquired business. That has a pretty significant impact on value. You need to understand what that's going to be. Of course, if you could discount it back to today for risk, and that risk discount has a lot to do with historical performance of the business. If they've historically grown the business 10% a year for the last 5 years, it's not unreasonable to assume that that business operation will continue to grow at 10% a year for the next 5 years. And so the risk discount applied would most likely be less. Clearly, discounting the cash flow as a converged entity, that DCF is important as well because you need to determine what will the impact be on your existing business. And, where is the real 1 + 1 = 3? And so there's some analysis there that needs to occur. And then, of course, there's internal rate of return. And we would recommend that all buyers look for an internal rate of return greater than 20%. And essentially what that means is that you've recovered your investment in that acquisition in less than 5 years of profit contribution in buying that firm. And that's a pretty standard, investment banking metaphor. What we found over time and over the deals we've done, that has proven to be a good benchmark to analyze deals and to make sure that as you're looking at the business that it's well within a comfortable internal rate of return. We think the threshold for not doing a deal is at 20%. If the IRR calculation goes below 20%, our advice is to not proceed. Reed?
One of the things that this also brings up, but I want to touch on it, and that is as multiples increase, if you're doing the math here, you're going to say, well, if it's 7.4 times trailing 12 months EBITDA, isn't that 7.4 years before I see a return on investment? The reality is that's true. And as we see those valuations go up and those multiples go up, this is where the importance becomes far more critical around that discounted cash flow on the converged entity. The reality is today it's going to be tough to acquire a company and get to the IRR that you need without, as a buyer, bringing either IP or value to the equation that's going to allow you to get to that return rate and still afford the multiples that the market's placing on the organization.
And I would add to that, I'm sorry, Reed, let me just make one more comment about the uprights. I would add to that essentially implies that there's a significant growth opportunity that you'll be able to capitalize on as a converged entity versus standalone entities. And again, that's back to that 1 + 1 = 3. The purpose of using the uprights as an analogy is that all deals, in our opinion, sort of happen from a strike price perspective between the uprights. So they don't happen at the discounted cash flow rate, which would be the right upright of the football goalpost. They don't happen at the historical valuation. They all tend to happen in the middle. And so obviously if you're a buyer, you want to look more towards the left upright, which would be more towards the historical valuation. And if you're a seller, you want that ball closer to the right upright or more closely aligned with the discounted cash flow. Reed?
So on average, 46% of the transaction is typically paid at close. We see numbers that typically range from as low as 40% or as high as 60% cash at close. There are some that do 100%. Obviously, that's the cheapest way to buy a company. If you're confident that the 1 + 1 is going to equal 3, you're going to decrease the cost of the acquisition by paying as much of it up front as possible. Typically, we see, though, that about 90% of the deals have some sort of earnout. And there's this misnomer that earnouts are risky. The reality is if they're built right, which is why you'd want to use an M&A advisor, but 74, three-quarters, 75% of the earnouts actually are realized. Most of those earnouts are based upon gross margin. That's probably the easiest way to calculate it. But it has everything to do with the ability to be able to track and measure that earnout. Gross margin is fairly straightforward. You'll see the number 2 option is revenue. If there's a lot of confusion on how numbers will be calculated, doing a earnout based upon revenue growth is certainly clear to all parties and becomes very easy to be able to track and to measure. Most earnout periods are 3 years. We do see them sometimes as long as 5 years. Don't see too many that are shorter than that. 2 years is about as short as it typically gets, but an earnout period is typically about 3 years.
A little bit about deal levers. Clearly, there are a variety of them as you look at how to use various types of currency to get a transaction done. It's clearly cash at close, and as Reed mentioned, that is the least expensive way to buy a company. It seems somewhat counterintuitive that would be the case, but if you believe in the growth plan and you believe in your ability to get a return on investment, you usually can get a bit of a discount on the value of a purchase by paying all cash at close. And by doing that and by achieving your growth rates, you tend to get a higher internal rate of return on that investment. Clearly, seller financing is common. This is kind of where earnouts also play. Either a seller note in the pure sense of seller-based financing, for which you generally, as a buyer, will pay interest to the seller and pay that over time. Earnouts really are also a form of seller financing, but they're typically performance-based. And the easiest way to structure an earnout, as Reed pointed out, is on a number that's really not fungible. And so if you're a seller, you clearly want to try to index that on revenue. It's probably the easiest way to do that, or gross profit. And there's a lot of reasons also why as a buyer, you want to do that. You want to make it easy to calculate as your financials begin to come together with a merged entity. There are horror stories out there about just the brain damage associated with the math in a converged entity if it's a profit-based earnout, and it can be very, very challenging to keep track of that. I think it would be easy to do, but as soon as you start to exchange resources and leverage, back office across both entities, it becomes very challenging to appropriately allocate costs, and thus earnouts that are built on net income can be challenging to pay out. Obviously, equity in the converged organization, this is a deal lever that we see, and if everyone is sort of selling in, if you will, into a merged entity, this is a common approach. We've seen a lot more merger activity, pure play equity swap merger activity as of late. I think folks are realizing that they need to be larger in order to compete, and or be more niche, if you will. And those two paths to success are pretty clearly recognized in the market right now. And so we see a lot more just pure play equity swaps in bringing businesses together, and that's an excellent way for companies to get synergy and grow and get to the next level of growth and profit. Employee agreements and creativity around how to deal with the seller's balance sheet are also ways to provide consideration to a seller. And the employee agreements, we've seen clients use that very effectively. Think of it as a way to overpay on an employee agreement or consulting agreement by a seller for a period of time. And that's, in many cases when that's done, that's considered consideration in a transaction. And I would also tell you any seller balance sheet, what we'll call value in excess, is a way that people will begin to utilize that as consideration. Or in the case of a seller, it might be leaving the business undercapitalized, lower than a 1-to-1 working capital ratio. And in short, that's the balance of current liabilities equaling current assets. Maybe they're stripping the assets out of the business and leaving more liabilities, or some such creative balance sheet activity will tip the transaction one way or another, either in the buyer's advantage or in the seller's advantage, if the ratio is not 1-to-1 at close. Reed?
So one of the things that we want to spend some time talking about today, here in the next couple slides, is really stock versus asset deals. And the reason for this is there can be as much as a 20% tax impact depending which way you go for either the buyer or the seller. Fundamentally, what's good for the buyer is going to be poor for the seller from a tax perspective, and what's good for the seller is going to be bad for the buyer. And so one of the places we end up spending a lot of time in negotiating transactions is really how we're going to handle the tax treatment of this transaction. And so there's values and advantages for stock as well as asset as you go through the process. As if you're looking at a stock deal for buyers, it allows a number of fundamental things for buyers. That lowers depreciation expenses. It's particularly of interest as it allows all contracts to be able to transfer because you're buying the stock, so there isn't concerns about any clients falling off because of contracts that they may have with the seller. And so all of those contracts are going to transfer as a part of a stock deal. You will, however, accept more risk from either things that may not be disclosed. You have liability that goes back to fundamentally back all the way to the company's foundation by doing a stock transaction, and you inherit any issues that may be with the employees. Mike, I don't know if you have further comments on that for the buyers.
Yeah, what's nice about IT services transactions is that there are specific advantages and disadvantages for buyers in a stock and in an asset transaction. And I would say the same for sellers. There are ways to overcome many of the tax treatment issues, and our advice is always to have a competent tax advisor, whether you're a buyer or seller, a CPA who knows their way around the tax laws, because they can advise you on your individual situation. But I think for buyers, depending on the situation, and every situation is different when you're buying a company, there's advantages and disadvantages to a stock transaction just as there is an asset.
So as we look at assets, the seller is going to retain possession of the legal entity, and the buyer is simply buying the assets out of the company. The buyers get to set up the company's depreciable basis in its assets. It's going to avoid, for the buyer, it's going to avoid liabilities, contracts, disputes, because all those things that their liability, the buyer's liability, begins at close and doesn't go backwards from that point. But there can be some assets that are difficult to transfer. Some of the legal ownerships, third-party consent, contract assignability are all typical things that start to weigh in for the buyer. The advantage from a buyer's perspective of doing an asset transaction, it typically lowers the tax implication for the buyer. In contrast, for the seller, it's going to come across as higher taxes, more in the form of ordinary income rather than capital gains rates. And so again, it's going to be really important that as you look at doing a transaction, either asset or stock, that you have good tax advisors that are going to be able to work you through that process. There's a number of tools that are available, and I would get to the IRS codes fundamentally, that will allow you to be able to work with this. One of these is the IRS code section 338H. Mike, I'll let you explain that a little bit further.
Yes, and this has to do with providing an advantage to this transaction from a tax treatment perspective. It allows buyers to purchase essentially a stock deal, but from a amortization perspective, they get to treat it like an asset deal. Clearly, this is advantageous to the seller because they can essentially allocate the lion's share of the purchase price to capital gains. So it turns out to be a win-win type approach. Now, there's specific situations where it is not very applicable. For example, if you've been a C corporation in the last 7 years, have changed your election to an S type corporation or LLC, there's some recapture concerns associated with using a Section 338H deduction. So it's not a one-size-fits-all, super silver bullet for every situation, but for many situations for private companies, it works well. The whole Section 338 of the IRS code has various approaches for different types of buyers and sellers. Section 338H is applicable for private buyers to private sellers, but there's different versions of that code for public buyers to private sellers and vice versa. So again, just like every point around leveraging that, or in a situation where it's an asset deal where the lion's share of the allocation is to goodwill, which will benefit the seller and look much like a stock deal, you need to have competent tax advice. I guess our takeaway on tax would be that generally what's good for the buyer is bad for the seller and vice versa. The key is to negotiate a good middle ground on tax treatment. That's the fair way to do it. And typically, regardless of whether it's a stock deal or an asset deal, you're able to do that.
So some of the misconceptions that we see as we get into valuations is, first one, 3-year contracts will make me more valuable. We hear that a lot. The reality is almost everybody's going to allow a client out on a shorter time frame anyways. There's usually ways to buy that out. It provides stability, and so I don't want to say ignore them, but the reality is today we see more and more what's valuable is to take a look at those clients that you have, how long have they been with you, what have they been doing historically, and that's a much better forecast going forward of what to expect out of the customer base of the seller than whether they've got super long contracts or short contracts. Today we're seeing more and more of contracts that are one-year evergreen contract with effectively a 30 days out agreement if they want to do that. And the reality is the pain for change is so great that few companies, unless you really screw it up, are going to really leave you as a result of it. And so as we look at contracts, it's more looking at how have they performed historically, and that's a far better perspective of what they're going to be like in the future than inherently the contracts they may have signed. Another misconception is wanting 100% of the cash at close plus the good multiple. There's very few transactions that are 100% at close. As we mentioned before, 90% of them typically have an earnout. The reality is the more cash that you're going to request at close or the more cash that is going to be guaranteed in the transaction is going to put downward pressure on the total value. Again, for a buyer, the more you put down means you're going to be able to get a better deal in the transaction. But for sellers, it's really rare that you're going to get all of the cash consideration at close. All I need is revenue. We see this time and time again. We've had some clients that have had super high revenue with very low profitability. The reality is the multiple is based, and all the valuation methodology is really based upon the profits that are realized by the company. You can't sell your way out of that. It has to be transferred into a tangible profit. Being diversified across multiple technologies makes me more valuable. We find that quite the contrary. The reality is the more focused you are, the better definition you have around your service offerings, around your target markets, what you're bringing to the table, provides a much greater ability for the buyer to be able to translate that into a return on investment as well as to determine how does 1 + 1 = 3. The more diversified you tend to be from a technologies and industries perspective means that there's more elements of the business. If I'm selling the company, there's more elements of your business that are not of interest to the buyer. And so the result is the more focused you are, effectively the higher the multiple will be that you're going to get. One that we run across consistently is a company's on a growth curve and realizes the truth that they're going to be worth more in 3 years. And although that very well may be true, the reality is you can't get paid for tomorrow's value. There's a lot of risks inherently that can take place in the next 3 years, and although you could be double the size in 3 years, you're not going to find a buyer today who is going to pay you for that future value unless you're going to do it in predominantly an earn-out type fashion, where you're going to both share the risk together and you'll both share the reward together. So what is valuable?
Yep, let me run into that. What's valuable? Obviously, consistent growth and profitable performance, preferably in the upper quartile of your specific area of specialty, the upper 25% from a profit perspective. You know, many of you guys know Service Leadership and Paul Dipple. He does an excellent job of benchmarking companies' financial performance in this industry. You know, we look at his numbers pretty carefully. We're in a partnership with Paul to understand those benchmarks and articulate them to the market. And I would tell you that, you know, in general, those numbers range in that, you know, 11 to 13% range from a net income perspective. You want to be able to consistently grow and be in upper quartile financial performance makes you most attractive. Clearly, long-term client and employee relationships help buyers be comfortable. Those are situations that make it easier to transition the business. If the business has had a lot of tumult and there's been a lot of, you know, contracts that failed or things coming and going or turnover in employees, makes it very challenging for a buyer to monetize that. Clearly, reoccurring revenue model for services is important. It adds value. It means that you're not having to resell the entire book based on a project-based business. There's lots of ways to build this into all kinds of IT services businesses. Obviously, infrastructure managed services businesses have led the charge on this with the way they have created subscription models. But we see project-based implementation and custom app dev companies and BI companies and others adopting this approach very rapidly and creating a significant percentage of their revenue as reoccurring. We've advised many companies in that transformation, and that is considered of interest to buyers because, as you can see, it just creates a much more stable revenue and profit stream. Specialization and verticalization, and I think any of you have followed anything we've written in Redmond Channel Partner Magazine or over the years in our blogs knows that the most successful firms from our perspective, the ones that have the fastest growth curve and the most profit realization are ones that are specialized and verticalized. They tend to have less competitive pressure. They tend to have a ready addressable market, and I would add the caveat that the market they choose to serve has to be large enough to achieve their revenue and profit goals, but that's considered valuable from an acquisition perspective. Most buyers want to buy a very specific business that's been fortified against the competition, and we think that that fortification can be achieved through specialization. Clearly, if you've developed intellectual property, I often call it the productized service, where you have either a code set or an approach that can be sold into the client with some customizations. That's considered valuable and will be, in the eyes of a buyer, something that makes sense. And then clearly well-defined offerings to a well-defined market that has consistently shown the performance outlined above as it relates to growth and profit realization helps make you much more valuable in the market. Reed?
So as we look at just a couple of lessons learned, kind of some tips that we've learned over the, well, Mike's learned over the 15 years of doing this, for myself the last 6. Really, you're going to end up negotiating to a tax-neutral position, one that's going to work for both the buyer and the seller and for the agendas. There has to be a recognition of tax treatment and just appropriate consideration given to all parties. One of the things that we found to be extremely helpful as you deal with the balance sheet is having a working capital ratio of 1. That's where the short-term assets are going to equal the long-term, or excuse me, short-term assets will equal the short-term liabilities. This allows the seller to harvest some of the profits that the company has built over the years, but it provides a very clear definition for both the buyer and the seller of how the balance sheet will be treated. Mike, do you have other comments on the balance sheet?
Yeah, you know, oftentimes there's only one time that a seller can harvest their balance sheet, use that term, is when they sell. And oftentimes buyers try to pad the working capital beyond what we consider as normative. What's normative in the definition of a going concern is where current assets equal current liabilities. And there's additional points of negotiation. Sometimes buyers will want to negotiate in a rent payment or negotiate in some length of payroll just to make that transition more smooth, and that's a reasonable request. But those requests would then be put in on the liability side of the ledger. But in short, to just make a simple example, if you have $100,000 in payables and you know, $200,000 in AR and cash, that additional $100,000 is your money as a seller. And as a buyer, that's excess working capital, frankly, that's owed to the seller. And so we feel pretty strongly that that is an appropriate way to bring over the business. It should, in theory, provide 30 days of working capital, long enough to transition the business. And it's an easy way to manage that. Oftentimes when that's done, however, you need to have a true-up period because the buyer, if some of that asset is trapped in AR, is going to need to have some time to collect that AR. And so oftentimes not all of the that additional value in excess can get paid out to a seller until their 90 days or so go by post-close. Reed?
Yeah, So the next two are tied together. The first offer is never the last offer. And this is part of the reason to use an M&A advisor. Inevitably, in the whole negotiation piece, at some point the baby gets called ugly. And one of the things that you'll want, whether it's us or another party, is an M&A advisor really to provide that type of buffer. When dealing directly, we just see pretty consistently nobody starts with the best offer, as much as they may say that. And so there's always this tension between the buyer and the seller. An M&A advisor will do a lot to remediate that and keep the parties working together well. But typically, what should you expect? As you look at buying a company, you can buy up to 1/2 your current size. It's not that you couldn't possibly afford more. It's just the reality of the cost of the transaction, how much leverage is required to get the financial leverage is required to get the transaction done. Integrating the two companies, really the threshold is right about half your size. It's about as big a deal as you're going to want to do, just when you look at all the complications that are involved with it. Most of the deals that we see today tend to fall into this category of about 40% of the transaction value is paid at close. About 30% is in some sort of guaranteed form, whether that be in equity or in a seller note. And about 30% of the transaction value is tied into some form of earnout or performance-based transaction or performance-based part of the transaction. So that gives you a general rule of thumb of where they land. Obviously, every deal is different, but that gives you a sense of what you should expect. Any other comments you'd have on that, Mike?
No, other than just every deal is different, right? It's important to note that every deal is structured slightly differently, and there's different motivations and levers to pull, as we outlined earlier. So be open to that negotiation and understand what you have the capacity to do. Our contact information is below. If you guys need to reach us, we'd be happy to provide you guys with this deck. Feel free to email us. We are recording this session, so we can make it available to you as well. We do have some upcoming events. We have a webinar like this in due diligence, which will be coming in May. And we also have a few events. So we'll be attending the Microsoft World Partner Conference in Orlando in July, and we'll be presenting there on M&A topics. We have a similar presentation occurring at Exchange, Channel Corp's Exchange Conference in August, and at IT Nation in November. And then I believe, Reed, you have a slide on our award that we're sponsoring with RCP. I would encourage the attendees that are on the line today to look into this award. This is an award we sponsored for the last 3 years with Redmond Channel Partner Magazine. I see today we have a few folks that have won the award in the past, but this is an award about excellence in growth strategy. And if you follow the link in the presentation, you can submit, you can review last year's winners and why they won. Also, you can submit, if you go to the Redmond Channel Partner Magazine website, you can submit a submittal to be considered for this award, and email that directly to Steve Becker. So without, Scott Becker, rather.